Okay, great. We're here. And actually, you're going to just see me looking forward now. The last couple of times we had somebody on the screen and people said, boy, I've been watching the back of your head for half the presentation. So we've got a great panel here and I'll introduce them because we only have 40 minutes and 40 minutes can go fast when you're having as much fun as we had on a pre-call, right? Right? So we're going to do that. I think because Matt's firm has been such a generous host, I will ask him to introduce himself first, a couple minutes, and then we'll get into the topics.
Well, I'll go even faster than that. I introduced myself earlier, and I think on this panel, I'm maybe the least competent other than able to see what funds are in formation and what's happening, maybe reflecting on what clients are doing right now in the market. And so I'm looking forward to this discussion. I as I mentioned earlier, I'm a lawyer specializing in fund formation, and that's my area. Should we pass to Maureen?
Yeah. Okay. So Maureen, we participated in these panels probably a half a dozen times. I'm going to say that she's one of the smartest women I know, except for my wife, in case she is listening on Zoom. But she's a wonderful lady. She's a wealth of knowledge, and we could probably do the whole panel right by herself without her knowledge. So how about a quick introduction?
Well, thank you. I don't know if I could follow that, Gary. My name is Maureen Downey, and I'm a managing director with Beneficient. Beneficient is a regulated trust bank, and we provide liquidity services to LPs as well as to funds. And we also have a primary investment program, which we invest in to funds.
Okay, and just like we have a repeat performance, Arun, you're going to be able to answer individual questions instead of going through the presentation. So why don't you give us at least 30 seconds or so, because in case people missed your earlier presentation.
Good morning, it's Arun with AK Global. So we're an outsourced CIO, and we provide a range of solutions for family offices and some larger advisory clients in terms of market outlook, investment strategy, a lot of manager research and due diligence, and sometimes direct involvement with the investment committee or the overall policy statements in terms of how they design their portfolios and manage their funds.
Okay, Gary Sawka, everybody pretty much knows me in the healthcare conference because I think I've attended about a dozen receptions so far. And USC, Harvard Business School, moved up the corporate ladder in CFO. And if everything went to hell in a handbasket, I was the guy that kind of wound it down or tried to restructure it. And then a public and private company board member, we do some work for companies in trouble for Crimson Growth Partners. So as I was coming in the morning, I was thinking, what's the best thing to start off? And there was a guy, I believe it was Edward or Downey, that said that the only thing to fear is lack of fear itself. And when we saw Arun's presentation, others, we saw that everybody seems to be put in some very narrow range. Very few people will talk about a downturn of more than 5 or 6%. Most people will say there'll be at least 3 cuts or 4 or 5 or 6. Interest rates won't go up more than 50 basis points if they don't go down. We're going to have a soft landing or a softish landing. There's no recession in, despite, a couple wars going on. Actually, it's third war now because looks like Venezuela wants to saw off the western part of the old British Guiana. So with all these things going on, Red Sea, logistics, other things, still seems like everybody is sort of like that character from What Me Worry. Remember that guy in the presidential debates? So what happens is that I think what I'll do is I'm going to go back and forth. Matt, I think I'll let Maureen do it first, only because she'll articulate some of the broader things, bring in yourself, and then go ahead with the room. Okay, how's that?
Okay. Well, thank you, Gary. And it's nice to see everyone today. Welcome. We had an interesting discussion yesterday for about an hour plus, talking about a whole range of topics besides what we're supposed to talk today, which is manager selection. And I think a lot of that wide-ranging discussion really stems from, how much change there's been, in the world, not only from a geopolitical standpoint in the last 2 to 3 years, but also just in the economy And then a lot of the speculation that's happened in the last, I would say even 3 months as to whether or not we're going to see, substantial cuts in interest rates and how much and when and what will be the effect on the economy. As it relates to manager selection, it was interesting after our conversation yesterday, a memo came out. I'm sure some of you are familiar with Howard Marks. I find him to be very informative, his memos. And I was reading through it yesterday, and it resounded quite a lot with me because, the upshot of that is that, we've come through a period of probably, I would say even 30 years of low interest rates and ultra low interest rates. And in particular, the last 13 years, we've had extremely low interest rates. And only in 2022 and 2023 do we see probably the biggest rise in interest rates, especially in one period, since the 1970s. And that's been a really big game changer, frankly. And I think it's really highlighted, how much investor sentiment had really changed and investor actions in the last 13, 15 years in terms of guiding how people made investments, what they thought was risky, where they put their allocations. And what I took away from reading that is that we are very unlikely to go back to a period where we had interest rates from 0 to 2% or even below 3%. That's my sentiment. And so what that means to me is you're going to need to think about how you want to allocate your portfolios, because I think increasingly over the last 5 to 10 years, we've taken on more and more risk, whether that has been, the increase that we've seen in venture capital or growth, because people have continually sought to get more yield. And so as a consequence, we've made more and more risky investments. Also, too, we've seen a real rise in alternatives, especially private equity, because, the cost of debt was so cheap. And so you've seen lots and lots of leverage, put on companies. The last time I saw, real leverage at scale being put on was in the run up to the great financial crisis in 2006, 7, and 8. And I've been investing for, the last 15 years. And so I started my career in the late 90s. And so I've kind of seen quite a few ups and downs. And I've also invested in quite a few emerging markets. So I've seen them submerge and emerge and submerge and emerge again. So when I think about manager allocation, I think about what are the macroeconomics themes that I can foresee in the next 3, 5, and 10 years. Again, I don't anticipate that interest rates are going to fall substantially. They may fall and have cuts this year, but the timing of which and the degree, I think, is still, not set. And I think the markets have been very optimistic already, as we saw in the run up to last year, in terms of pricing a lot of optimism. And so when I think about what I would like to see in terms of a portfolio allocation, one, I think the credit strategies still remain very attractive and probably more of a shift toward fixed income. Two, when I think about managers, I think a lot about those managers who have experience not only operating companies, but also being very thoughtful about capital structure and how to manage capital structure. Three, because so much money has gone into venture and growth, not only in terms of funds, but also the underlying companies, what I think you're seeing more and more of, and this was already something that we were seeing, say 5 years ago, is that there is a great pressure for liquidity. And so I think secondary markets are going to become increasingly interesting. They're already quite developed on the private equity side, but they become even more so in credit and real estate. And I think for the first time, you're going to see a lot more activity in the secondary market for growth and venture capital companies.
Yeah. So with that piece, because we're going to get back to you, you said the magic word, and that is real estate. We had in our pre-call, I was telling Matthew, God, Bloomberg said 30% vacancies in the San Francisco market. You said, no, I think it's about 35 or something like that. So you might have a lot of business to restructure some real estate companies, because it seems like they can't refinance at anywhere near these interest rates.
So let me just talk about, reflect on the secondaries first, and then I will talk about the real estate. And Maureen, I don't think you were here during Arun's presentation, but he basically said something very similar. So I think there's agreement there. From my perspective, I am also seeing early stage venture funds that were formed over the last decade that have a number of portfolio positions they need to figure out how to deal with, and they're getting to the end of their terms. And they're starting to say, what do we do now? The term of these documents ends soon. And a lot of these companies are still kicking around, and there are quite a few of them. One of the things I mentioned yesterday that's interesting, I think, is venture capital funds have to rely on an exemption that requires them to invest 80% of their capital directly into portfolio companies. Only 20% of a venture fund could make secondary investments. And the venture exemption is very powerful. It means you don't have to register with the SEC. You don't have as much sort of headaches to deal with. So a lot of venture managers want to stay in that exemption. But it also means they can't readily go out and just buy secondary interest. They have to focus on these direct investments into portfolio companies. So there's almost a sort of an area there of imperfection that venture people who might know these companies are limited in making the kinds of investments they need. And you might need to look at secondaries funds that are dedicated, and those managers have to be, if they're larger, have to be SEC registered advisors to get in there. So that's something I think there is an issue that needs to be addressed. I agree. Almost looking at some of your charts earlier, Arun, it looked like we were in sort of the hangover phase after the party. And the question I have is really, how long do those typically last? It always seems like there's a period of digestion after a phase like that. So I'm interested in your perspective on that. Lastly, real estate is one of those areas. I think REITs kind of bounced off towards the bottom. They kind of went down like this, and they're bouncing up a little bit. But we've got office vacancies, and we talk all the time here. This space obviously is not vacant, but just trying to get people in. So you've got in San Francisco above 30%, and other markets similarly high. I think maybe not quite as high, but there is a challenge post-pandemic in just filling up offices and bringing people down here. That I think that's one of those things that, to me, it may take some time. It may take interest rates coming down, but also culturally, are we going to come back into the offices more? So I'll stop on those things.
Okay, good. Yeah, it is really a problem, because my first jobs out of school, there'd be a guy sitting there, and you'd come in at 8:05 and he'd tap on his phone and say, work time is 8 o'clock. You know, I mean, it's we there 5 days a week for your 12-hour shift or whatever. So one thing I thought, Arun, you'd be able to tell us is that, you know, there's so much government money that's been spent on different programs, and so many opportunities to consult with this. So whether it's the state governments or the local governments. So if there's a guy who's an outlier, maybe all the guys on Fox News being the outliers, who are bad-mouthing the governments in many ways in terms of overspending or whatever, do they sort of have to cheerlead for the guys that are paying their bills or giving them the consulting? Because there's no, and so therefore, even though you might privately have different viewpoints, are you still trying to get jobs? I've heard that from one Harvard Business School professor when I said, geez, sounds like you're a cheerleader. And for the Biden administration, he said, well, I do a lot of work, okay? So I didn't know what his private views were, but I knew in public when he gave a presentation that went on Zoom, he had to do that. So do you think that, including things like the deficit, which seems to have gone away, $1 trillion in full employment, doesn't matter anymore? Is that no longer an issue until it might become an issue?
So I think, so a couple of issues with that. So the government is forcing by mandate into many areas production for a product that may or may not have demand. So specifically with alternative energy, you can mandate EV vehicles at a certain level, you can mandate wind, and you can mandate solar, but if the market's not there, you can only go so far. So I think we've already seen a couple of large scale cancellations in the East on wind projects that were some very large firms that had said, we're going to do this at this dollar cost. The cost curve changed because of rates, and they canceled the projects. And the same is true with semiconductors, where the government is saying, build in America. You go, well, there's this different cost structure in the US, so it may or may not follow through. But I think it definitely distorts the market. So the issue is that you have a lot of money going in. It's distorting some of the underlying markets, and there may or may not be demand. Even the UK, I think, pulled back on their mandates that we can't. I think they had a 2035 mandate. They had a certain target for alternative energy or EV production. They said we can't hit that. We're going to reduce that. And Ford had invested based on that commitment that the government had made. And Ford had a lot of money at stake, and the government said, we're not going to make that. We're going to withdraw that mandate. So I think you're seeing a lot of distortion in a lot of these markets with the money that's come in, separate from the other kind of Matt, your comment on the time frame. There's so much money now in all these categories, venture and private equity and private credit, and I think there's overlap now. So the large firms, the KKR and the Apollo and the Blackstone, they have all of these funds and they overlap. So when you look at the private equity fund, it has the potential to do private credit. They're doing private credit. They can do some lending. You look at infrastructure kind of overlaps with private equity and private credit. So you have a lot more. I think they're not as pure. The funds aren't as pure as they used to be. So from a manager selection perspective or an investor selection perspective, I think you have the choice to say, do you want a broad fund or do you want a narrow fund, and how focused do you want to be? Even the large shops have overlap. They're sharing investments, especially on the infrastructure side. So I think that's something to be aware of from the investment perspective.
I just have a real short comment on that. In 2002, I said this a little back quick, there were 30,000 financial products being sold in the United States. In 2023, 740,000. Talk about your blended products and offshoots, etc. I mean, it's an explosion in financial products.
Yeah, I think
Yeah, and there's actually a bet on the sports market is whether we'll go over a 40-minute time limit. There's a guy, I know it's fun. I'm a real, USC Trojan fan, so maybe I'll take a bet on his. Okay, so interest rates, what do you think? Are people, the prior president said, let's issue 100-year bonds. Argentina does it, other guys, and of course they'll never be able to pay it without restructuring a dozen times. But but then the Treasury says, no, we've got to keep, the mark. We can't radically change anything. Should have, the guys who did issue 10-year, 20-year bonds like Google and Facebook and others, they have bonds that are now, or Apple, they have bonds that are trading at 50 cents on a dollar now that they could buy back if they wanted. So do you think the government missed an opportunity, and now that deficits are going to rise up now that they didn't make out of the normal situation move?
Yeah, definitely. Yes. So you had the chance to borrow it when rates were 0.5 to borrow for 20, 30, 40, 50 years, and they didn't do it. So absolutely, yes. And part of the reason that the feedback loop or the lag has been so long with the rates rising is that the private sector did do it. So the firms with the worst balance sheets, Verizon, the AT&T, the CVS, and all those firms, they all borrowed long. So they're not exposed to rates rising today because they've got huge debt, but it's not due until 30, 40 years from now. They've locked in at 1 or 2 or 2.5%. So they're just not impacted by the Fed raising rates today because they borrowed so much at such low rates. So that lag effect is almost, there is no impact because they're not going to market to borrow, and they have enough cash flow to cover what their needs are today. So the government for sure missed an opportunity, and they shifted their borrowing in November to go back to short term to take pressure off the long end of the market. And the government's trying to manage the debt because there's too much debt in the system. So that's a big management tool for them, how they manage the duration and the maturity structure. But certainly, given the debt that we have today and the fact that the deficit still looks like it's fairly large, going to be paying a lot more for that borrow cost. I think the interest costs are now almost $1 trillion. It's a big number. I think it's a huge number at the federal level.
Yeah, and getting higher every year, right?
Well, it's going to come out of programs.
So Maureen, you brought up that, but also you brought up the fact that a lot of these guys that made the VC investments, aren't really numeric people, and that the private equity people who might buy some of these investments at deep discounts have much more discipline and may come to the rescue of a lot of these things, albeit at very deep discounts.
Yeah, I think that, you saw basically starting in 2010, 2011, which I would say was also a really great vintage year period if you were investing in venture and private equity and growth right after the global financial crisis, because a lot of people weren't investing. So if you got into some of those vintage years, it was a great time to be in the alternative markets. But you also saw at that period of time, a real growth in terms of money coming into venture. I think the traditional venture capital firms raised about 3x the normal amount of capital that they normally raise, like say in 2010 to 2020. But what you saw more importantly come into the market were all of these non-traditional venture capital and growth investors. So you saw sovereign wealth funds, you saw SoftBank, but you also saw a lot of the mutual funds like T. Rowe, Hartford, many of those mutual funds that previously hadn't really come in and been investors, in the private space. And the reason why they did is because the period of time for when a company went private or was private and formed, and when it exited back in 1999 was about 4 years. And now that duration is about anywhere from 12 to 14 years. So in order for them to come into, say, the slope, where you want to get I would say the steepest part of the slope of a company's growth curve, you actually had to come in when the company was still private, because back in like 2017, 18, 19, 20, and through 2021, you had effectively private IPOs, people that were doing, $100 million to $500 million raises. That's like a private IPO. And so you saw a lot of these, say, traditional public investors start to become much more active in the private markets. And so that was a lot of money that just previously wasn't there. And so that extended the lifespan of when a private company could stay private. Now, a lot of that money is retrenching and it's not there. This is probably the hardest, the last 18 to 24 months has been the hardest time for venture funds in particular in growth to be able to raise capital in probably 20 years. So you're seeing a real liquidity crunch on multiple levels. And I think what's going to be needed is for those funds, as Matt mentioned, that are past their extension period and their LPs are clamoring to get, their capital back, you're seeing a lot of what we call GP restructurings. Two, you saw like with Stripe this last year, they had to do some structuring in their capital structures. They had a number of their employees and early investors wanting to get liquidity. So there's a number of, I would say, pain points for, especially in the private venture growth and private company space, wanting to seek liquidity structures. Previously, I think a lot of the expertise for venture and growth investors has been to help companies grow, help companies scale. But as the liquidity situation has become more complicated, I think you will see more individuals or professionals that have a more structured finance skill set try to solve for some of these capital structure issues. And now, I think I was looking at a report, the secondary venture market is trading at around 40 to 50% of where NAVs are currently marked. That's as of the end of last year. Yeah, and it still hasn't hit bottom from what at
Where do you
least.
think those NAVs should actually be marked?
Well, that's a very good question. So, so it depends on what we're talking about, private equity, growth, or venture, right? Because if you look at 2021, that was a banner year for venture. And most of those valuation rounds were struck at really high levels. If you take a look at how companies are being valued on the venture side, many of the managers don't actually want to recognize anything but the last round. So if you haven't raised capital since 2021, you're holding your company at a pretty high valuation. Now, if you are an audit firm and you are looking at a VC's fund portfolio and their last round was done in March of 2021 and it's now the end of this year, you start to get pressure to say, hey, this is getting a bit stale. We need to revalue this. So then you take a look at private comps, public comps, mutual fund marks, if it's a later stage company, and that starts the debate. And no GP who's trying to raise capital now for their next fund really wants to mark down their portfolio and show unrealized losses, especially when they marked it up so much during the last round. So that is the real conflict.
So
Yeah, this is a philosophical aspect to this, which is that many firms who are trying to raise money for the next round are doing gap financings, and they're pushing out notes. They don't call to change their valuations at all. They just convertible notes that are convertible into 2 or 3 years from now.
Yes.
right? And that's a nuance.
And
that
safes,
people aren't
multiple
recognizing.
safes.
Yep.
Yes.
So that, I think that's the big issue is that the multiple is still wrong. So the public markets have taken the mark immediately and the private markets have not. And so just to go back to the reference point I had in the presentation initially, so the price of sales on ARC went up to 12 times from 4 to 12 on sales and then from 12 back to 4. And that's approximately 70 or 80% correction in ARC, which is similar to the NASDAQ in 99, which is about 75%. And that's not the mark that's been taken in venture capital. It's maybe 15 or 20%. And the discount to NAVs is showing up in the secondary market. So I think the difference today is there's more money and there's more visibility across secondaries and venture and portfolio companies that investors aren't going to say, well, that fund took the mark and I can see it's a 20% mark. And those fund didn't take the mark and they have a different valuation and they're still collecting a performance fee or whatever it is that they're doing. And you're going to see that discrepancy. And I think so this is a year of debate or reconciliation. And if the public markets fall further, then the multiple there's even more pressure on the private markets because the multiple on the public market is still pretty high. So I think but I think that takes at least a couple of years to work its way out because there's so much cash still in the system. And because there's so much volatility on the credit side, the discount rate was 5 a month ago, and then it went to 4 in 30 days. And it goes back to 5 again by February. And you have to come back and say, well, the discount rate's gone back up. You have to take, the private firms have to take some mark on that.
Well, we mentioned one thing in our earlier comments. Maureen mentioned the public, the CalPERS and the CalSTRS and others who went into venture capital in a big way, probably at the exact wrong time. And if they got marked to market, unfortunately, they're kind of have to make their payments to their pension people who obviously make a very good pension compared to comparable public jobs. So is there then, a bailout that we needed? We're talking about, I think, trillions of dollars of unfunded, besides, unfunded Social Security and everything there. So what happens there? There's a lot of public funds. They can't really not pay them. Yeah, you might have some muni restructuring. I don't think they can do it, can they? There's going to have to be a bailout, or there's going to have to be something big because Gavin's got a $64 billion deficit this year, but it's not going to help him too much. So he's not going to be able to bail them out.
Well, yeah, so California's, I think in the next, right about now, he's got to come out with a budget proposal, and he's going to have to come out with something that tries to address this, probably involving furloughs for state employees, some stuff like that, cutting some programs. I think it's a big issue, and I kind of defer to the others about unfunded pension plans across the board. I think you mentioned one that's fully funded, Wisconsin, maybe, but otherwise, it's a mixed bag, I think, and it's a real challenge, I think, for governments going forward.
So what?
We have 10 minutes.
Okay, 10 more minutes. Well, why don't we? Yeah.
Selection business, that'd be great.
Okay, we're gonna just do 2 minutes of our 10 minutes on Bitcoin, digital gold, or as Jamie Dimon would say, really not necessary, probably just a big fraud. The ETFs are either going to come out today, or I guess somebody want to jump the gun and hack X to say that it's already been approved by the SEC. Any comments from any of you three?
Well, let me just say this. I guess the SEC was hacked, I believe, is what happened. And of course, that's an interesting issue because they are, the finger wagging regulator for other people getting hacked. And so we'll see how that plays out. I do think they are about to approve a Bitcoin ETF and not just one. I think there'll be multiple ETFs that'll come out in the next couple of weeks. That's my guess. But I understand that Coinbase stock has been coming down, maybe because people are thinking, why wouldn't I just buy an ETF of Bitcoin instead of trading all kinds of other currencies? Beyond that, it's all speculation, really.
And I have 2 comments, which is that Coinbase Ventures only invested in existing investments last year. Invested in no new crypto companies. Meaningful. And then number 2, I think Gary Gensler is the most important person in the United States for crypto. He's pretty negative. Like, didn't he put out a statement before they got hacked? Like, before they got hacked, that said there's a chance that it could be fraudulent.
He's,
It seems like.
I think if there's a Bitcoin ETF approved, it's against his wishes, but it's sort of, he sees the train moving and I don't think he thinks that it's an area where there's a lot of fraud and maybe they just feel like it's better to try to regulate it some more.
Maureen, you had some comments more on the use case as to what it was, right?
Yeah, I mean, I think Gary Gensler has been very aggressive, with regards to his stance on crypto, and you certainly saw that with a lot of the collapses of a number of the companies, especially last year and the year before. I'm thinking of BlockFi, and I'm thinking of a number of other ones. I do think blockchain technology, though, has a lot of uses. The technology itself. What we were debating a little bit yesterday, because there's been so many cases put out there in the financial sector in terms of digitizing real estate or digitizing other types of assets. And the question that I put out to the group is that I do think there is the technology to be able to do this. But just because you build something doesn't mean that people will come and people will want to use it. And so I think that's a very important question. A lot of people have talked about digitizing, LP stakes or digitizing, private securities. But sometimes I ask myself, do the managers who manage those assets or those funds, do they really want that transparency? So I think you have to consider that a little bit too. There certainly are investors who might want that transparency or might want more of that democratization, but I think you have to look at the different constituents around it. Certainly for payments and the ability to lower costs using blockchain technology is, great, and it has many applications. But I do think, looking back over the last couple of years, there was a lot of obviously press and discussion around DeFi and decentralization, but there is a role, I think, for the regulators to play, because certainly having looked at how many folks, especially retail, but also institutional, some pension funds also came into investing in crypto, money has been lost. And so I think that's the role that the regulators play, is to make sure that your retail investors don't lose money. And so we are still playing it out. The interesting thing to me is whether or not the US has taken the current stance and has been slower to maybe adopt regulations versus other countries. It seems like they may be happier to have some of this crypto activity move offshore rather than have it in the US. But again, I'm not the expert here.
Yeah. Ruin, any quick comments before we move on to manager selection?
I just think overall, if it grows large enough that it dilutes the sphere influence of the US dollar, it's not a positive for the US, and ultimately the US government won't allow that.
Yes.
So I don't know how that plays out. And it works for China and Libya and Russia and whoever else you want to put in that mix very well. And it doesn't work for the US. So I like the technology. I agree with the blockchain is completely separate as a technology. But Bitcoin, I mean, I would never say this about anything else, but I don't think they can allow it to happen. So
I agree with you that it's a threat to the US dollar.
and that's a big deal,
Yeah.
especially now with the debt and deficit. And they're going to digitize a coin, which will be tied to the central bank, which will be tied to the US dollar. I can see the government doing that, it'll just be digital, but it'll be the US dollar. So it'll be controlled by the US government.
Okay, so now, just in the nick of time, we get to manager selection. And I think I'm going to start off with Maureen, because she says, despite the fact that you might want to change some managers, the best of all managers are kind of locked in because you can't get rid of them. You might not get them back again when good times return. So why don't you elaborate, and we'll get some quick comments on the other folks.
Well, what we talked about a little bit yesterday is I think it depends what type of investor you are, how much of your budget needs to be funded from your cash flows, where you are in the construction of your alternative portfolio. Many times, if you're in a really good manager, if you pass on their next fund, you may not be able to get into their next fund. And so that is a consideration for a number of, say, endowments, foundations, pension funds, when they end up having to pass on the latest fund. Two, different institutions have certain percentages of our operating budget that have to be fulfilled from those cash flows, and they may not have enough cash flow to re-up in every single manager. And so you have to make hard calls. Third, there is, the decision as to, do you want to change your, trying to think of a sports euphemism, and I'm failing miserably, but do you want to basically change your lineup? And I think it's equally important to figure out when to drop a manager, as well as to maybe bring a new manager in. There's been a number of initiatives out there over time to do emerging manager investment programs. And I do think many times first and second time funds perform actually quite well. But when they get to third, fourth, or fifth, their performance drops off. And so having to think about, is this a manager that you want to continue to keep in your stable, or do you want to rotate it out? And then I also think a lot of it is, it is the nature of managers to keep trying to increase their fund size for the most part. And so a manager who's writing a check of 15 to 25 million has a very different skill set than if that manager then starts to write a check of 75 to 100 to 125 million, in the same space. It's a different type of company. And depending on the country, you may not have as many opportunities. So there's many things that you need to think about when you're looking at that suite of managers. And then finally, I would say, depending on the size of institution, you may want to concentrate your manager roster so that you can get more fee discounts or be able to get co-investments, which then again lower the overall amount of fees and then raise your return profile. So there's many things that go into, I think, selecting managers, and a lot of it comes down to your investor profile. I will say, though, that from my experience, when there is really tough fundraising environments, those investors who keep allocating tend to find that those are the better vintage years, because those managers really work really hard to raise the dollars and are extremely thoughtful about what they invest in if they have the discipline.
So Matthew, in Bitcoin, there's probably going to be a race to the bottom and fees getting substantially cut now from the 2% or whatever they were charging. Do you see any pressure on fees there and in your areas like real estate or restructuring and stuff, or?
Not, and I will say in the last couple of months, I have talked to people doing cryptocurrency funds 2 and 20, and I have thought to myself and mentioned a few of them, why would someone do 2 and 20 if there's a Bitcoin ETF coming, which is going to be 30 basis points, and the fundraising environment does seem to have slowed down for them. Real estate credit, I don't see it drawing back that much. People are still, trying to get fee discounts for the size for larger checks, but it doesn't seem to be an area that we're seeing a lot of change in.
Okay. Any comments from
Just on what Maureen said, I would echo the comment or agree with the comment that an investor feels compelled to invest with a fund because otherwise they can't get into the fund. So if you look at the passive investors, they are basically valuation unaware. They're just putting the money into passive funds in the public market. If private investors are doing the same thing in the sense that they want to be part of the fund, they are also effectively valuation unaware in the sense that if it's not the right time to do it, you actually shouldn't do it. You should say, I got to wait, I'll come back in 2 years from now or whenever. But if they can't operationally, then you have more pressure on the multiples to make less and less sense. So if you look at the market today, there's a huge dispersion across public value multiples across sector. And I'd argue you're going to see the same thing now in venture and private equity because there's so much money and the secondaries are going to step out and you're going to say, well, how do you make sense of the multiple? It's not as transparent. So some people are going to see it, a lot of people won't, depending on who's in what fund and how they get marked. But there's such a dispersion and there's so much money coming in just to come into the space. I think you get that valuation distortion for a longer time period.
Yeah, well, question, I'll make a comment on this. If you look at, say, industrials or consumer discretionary or consumer staples, and you look at like, say, Case-Shiller indexes over a long period of time, you can see what the average multiples, are that are trading. And you can kind of decide whether they're undervalued, overvalued. It kind of is the long-term averages. When you get to venture growth, emerging markets, because those companies in their life cycles are changing so quickly, it's harder to get those data points, right? And so it's harder to figure out like what's the right valuation. So to to Arun's point there, I think when you kind of dollar cost average in, or you kind of make sure that you're kind of constantly deploying capital, one of the things that I always look at, like when I'm looking at a secondary opportunity, is I'm like, where did they buy in? Where is it marked now? And then if I think it's going to exit in like 4 or 5 or 6 years, what should be the multiple that I'm putting on that, say, EBITDA or that revenue that I think is more sensible, right? And then how does that price relative to the current NAV mark? It's easier to do that, I think, with buyout companies, companies with more stable capital structures. It's much more challenging to do that with growth companies or earlier stage companies because their EBITDA and their revenue numbers are changing so quickly, their margins. And that's where it becomes quite tricky. That's also where I think there is a role to play for structured finance, where you can kind of share some of the upside with the, say, existing investors. But maybe if you're coming in as a secondary or someone who's helping to try to transform that capital structure, mitigate some of the downsides, if that makes sense.
Okay, well, those are great comments. Looks like we're getting Marty to tee up the next guys.